Okay, welcome everyone. As a starting point, I'd just love all the panelists to give a quick introduction to themselves. We'll sort of go down the line. We'll start with you, John.
Yeah, hi everyone. I'm John Sharp. I'm the founder of Hatcher Plus. We're a global platform that leverages AI to do deal selection. And also we have an integrated front office, middle office, back office solution that combines multiple accounting systems and works for family offices to VCs to PE firms.
Hi, my name's Jason Edwards. I'm a partner at January Capital. We're a seed stage B2B investor in Southeast Asia and Australia, and we also do venture debt for growth stage companies, and the founder of Alternatives.pe, which provides the financials, cap tables and valuations for all of the startups and now private equity, M&A as well across Southeast Asia and Australia by pulling the regulatory filings.
Hi, my name is Jijin. Thank you, Steve, for inviting me to the panel today. I lead market strategic investments for Citi. We are part of a global team that's also based in New York and London. We've been around for the last 15, 20 years, investing in over 100 companies globally.
Good morning, everyone. My name is Jeff. Thanks, Steve, actually, for having me here. I'm a partner with iGlobe Partners. It's a Singapore-based cross-border deep tech early stage VC firm. iGlobe has been in the market for 24 years. So what makes us different from other Singapore-based VCs? Actually, we primarily focus more on deep tech. We primarily focus on companies actually in the West Coast of the US as well as the UK. Of course, we also support Singapore companies actually in scaling up to other markets like Japan and US. Apart from deep tech, we also over the years have been doing a lot of deals in healthcare as well as Fintech as well. Thanks.
Thank you very much. Now, Jason, I'm going to start with you. You mentioned about offering sort of venture, offering debt as well. So obviously that brings up the question of equity versus debt. So how do you balance that offering and what you provide to companies, when you're looking to make investments? How do you decide whether you're looking at an equity opportunity or you're looking at a debt opportunity?
Yeah, we have a very separate strategy. So we're equity on the seed stage, investing in B2B businesses, and then on the growth stage, we'll look at doing venture debt. The reason we did that, we saw a gap in the market. The existing venture debt players in Southeast Asia were doing checks of 5 million or less, and no one was really providing that $5 to $15 million range.
Brilliant. And for you, John, you mentioned about utilize AI from a decision-making standpoint. So just give a bit of an understanding to the audience how that takes place and how you see that AI assists from the decision-making and what kind of advantages it brings from both the investors and also the GP side. Sorry, the LP and the GP side.
How much time do we have?
It's literally on the clock.
Okay, very good. So we started doing AI about 8 years ago, and the intent was to basically try and figure out a way to get predictable returns from venture capital, which we all know can be very unpredictable. And I think everyone in this room has probably got a story of making an investment in a startup that you thought was going to be amazing and didn't turn out that way, and vice versa. And so we'd actually invested in about 20 companies prior to going into the AI direction. And it was very hard for us to predict which ones were going to do well. So we started looking into what we could do by taking in a very large amount of information. So we've taken in about 600,000 deals into our AI, into our model. And from that, we're now able to predict, we're able to give them a Hatcher score and predict which companies are going to do well. About 3 years ago, we started doing this for the portfolio level. So we started looking at how we could create a portfolio structure that would create a predictable return. But in the last 2 years, we've been tracking 40,000 companies, and we're now able to demonstrate, there's a data science term, but demonstrate significant lift of up to 9x on our models. So what that means is we are now at a point where if you score 900 in our system out of 1,000, we kind of know what your follow-on funding is going to look like. We know what the outcome is going to look like with a great deal of probability or very positive sort of understanding what that looks like. Likewise, if you score below 500 in our system, we know what that outcome looks like as well. So this is a first. No one's done this yet. There's various AI approaches that have been taken around the world. The reason that we're here is that we started 8 years ago. Dan and I thought this would be a great idea a long time ago. So we've been down all the dead ends and all the cul-de-sacs and gotten to a point where we've got a model that now actually works to predict which companies are going to do well from a pre-seed or seed stage.
Thanks, John. And Zhijin, whenever I think about you, sort of go back to my opening address of, when I mentioned that, what I love about these types of conversations, you get this amazing helicopter view. I can only think, sitting in one of the world's largest banks and sitting on the deals team, the amount of deal flow that you would see as far as what's happening in the fintech space. Being in Asia, it's obviously been an incredible transformation. I remember first coming here 10 years ago and just having to pay cash everywhere to now where everything is literally cashless. So what have you seen as far as transformations, over the last couple of years, and then what do you have your eye on going forward?
Absolutely right. As you said, I think fintech has radically transformed the venture capital space within Asia, whether it's in payments, whether it's in lending, in KYC. We've seen a lot more payment methods today, wallets, QR codes, instant payments, Pay Now in Singapore, Pay To in Australia. There's a whole bunch happening there. In the lending space too, with connectivity, increased mobile usage, etc. Definitely there are more fintechs looking to connect lenders and borrowers in various different ways and using data that didn't used to be available before for alternative credit lending. So definitely we're seeing a lot of more new methods or access to credit in Asia as well. Increasingly, we're also seeing how digitisation allowing more smoother UI experiences for the various users. And of course, financial inclusion is a very major theme within the Asia-Pacific region. I think what we are seeing now is also as regulators are more experienced with dealing with some of these fintechs, they're also starting to put in guardrails. For example, capping on the interest rates that are being extended to some of these unbanked or underbanked to ensure that they're not exorbitant. Putting in caps in terms of how banks can work with fintechs and ensuring that not all of the risk is passed on to the fintechs. So these are some of the trends that we're seeing as well in the Asia-Pacific region.
We'll talk about it afterwards, but I find it interesting how fintech went off the radar for a lot of people for the last sort of two, but then all of a sudden, in Australia specifically, it really came back on the radar with a vengeance. But we'll cover that sort of down the track. Now, Jeff, you're in deep tech. You mentioned you're in deep tech. Not the easiest of areas to start with, but also you do it cross-border as well. What are some of the unique challenges that you found in, number one, access, in sort of assessing deal flow, but then also managing portfolio companies in cross-border investments? And then also, what are the trends that you're seeing?
Yeah. Okay, so when I say deep tech, right, actually my scope is pretty wide, actually. We are talking about many things actually now AI, right? So for example, I give you certain examples, like we are looking at, everybody knows actually AI computing actually is very power inefficient today. Actually, there's a growing pressure of how you can enable large language model be running on edge device like earphone or some other device actually for consumer, right? And today, the kind of chipset just simply doesn't enable that, right? So how are you going to run Llama 7B, Llama 27B actually on a piece of earphone? But you'll be able to see that actually somewhere now, maybe 24 months from now actually. So I think that's a very huge opportunity for ourselves. And many even application areas actually involve a lot of good talent to make the kind of vital service actually is implemented. So I think it's actually a lot wider for us. And apart from that, right, we also look into fields such as actually quantum sensing, or maybe things such as and a few other domains actually. So traditionally, right, so most of the deep tech deal flow will come from places like Boston or Bay Area or Oxford, Cambridge, and certain part of Europe, right? Because we're in the market for 25 years. If you think about actually what iGlobe used to do in our first one was actually closed in year 2000, right? We have a lot of semiconductor deals at the time. And we have a lot of deals actually involved with enabling kind of components actually for telecommunications back 25 years ago. So it was quite natural for us to come back to this space when we start to see semiconductors start to revive, right? And over the years, I would say we never lose our touch point with this ecosystem. Silicon Valley is all about silicon. You think about it, right? The biggest company, the Silicon Valley today actually is NVIDIA. So this actually has, I would say actually we're very comfortable with that, right? Come back to the question about the deal flow, right? So over the years, actually, we ourselves, even though based in Singapore, we spend maybe 1/3 of our time traveling over there in the US and UK, and then every time we go there, we try always spend a lot of time to study and understand actually what's evolving over there. And you can see over the past 10 years, actually, there are a lot of changes, right? So it reflected in kind of deals actually we do over there also. And how do we manage these portfolios? It's indeed a challenge. I think it's not easy. So very often
Sleep becomes difficult, that's for sure.
exactly. I mean, in cases of we are a small investor in many cases, right? So every time, I think most of the cases, maybe only out of the deals that we done in the US, maybe 20% we got a board director seat. Maybe remaining kind of companies, we only have a board observer seat, right? So they will not accommodate they will not actually. They will not do you a favor by trying to schedule in a way actually which is easy for Singapore-based investors. So sometimes actually I was forced to get up at like 3:45 a.m. for 4 a.m. call, which is 4 p.m. Boston time. But you just have to do it, right? I mean, it's difficult. But what I've been doing to improve the situation is over the past 3-4 years, we've been hiring people to be based in Boston and also in Silicon Valley. And some of these senior people, actually, they'll be able to actually represent ourselves on the board, and so very often, right? So what we really leverage on them actually is to ask them to bring the operating expertise to help those founders. Like we have a company, we have operating partner based in Wholesale who has brought a few companies to Nasdaq before. So he was the one actually able to actually guide the founders actually how to prepare the company for. Get ready for listing, all this kind of stuff. We have another venture partner based in Boston who used to run the Techstars in the East Coast. So these people actually, they can command our respect from founders and co-investors as well. So that's how we help to improve our capability to operate over there in the US.
Brilliant.
Thanks.
And Jason, for you, the area of B2B doesn't get really talked about too much on sort of panel sessions, and that's your focus. And for me, I'm curious as, obviously I've got my thoughts on B2B. I sort of mentioned it in my opening talk. I'd love to hear your perspective. What's your focus when you're looking at opportunities right now? What are you looking for at the seed stage for B2B opportunities?
Yeah, it's a great question, Steve. So when we launched back in 2015, we were methodical about thinking what should be the right strategy in Southeast Asia. Should we be B2B, should we be B2C, or should we be a combination of the two? And then we thought about what's really going to drive the success of those businesses. So a B2C business will require an enormous amount of capital to get to break even and have a successful exit. And to get to an enormous stage, you need a very big market. And people think of Southeast Asia as one market of 650 million people, but it's not one market. It's fragmented, different cultures, different languages. And B2C does not travel well, usually, across different cultures and languages. So we just didn't think B2C would be very, very attractive. B2B, we thought you can get to profitability with much less capital. They're very capital efficient. That means you can have exits at lower valuations that are very successful. We've had exit at 150 million doing 10 to 15x. You'll never see that in B2C businesses. Where you've seen B2C exits, they have to be very big. So the chance of it, most of the exits across the board worldwide are M&A. IPOs are probably 5% or less and getting less. The number of public companies, as Steve pointed out, has decreased every year for 30 years. So you've got more take privates than IPOs. So you've got to look at M&A. The bigger your valuation, the less number of buyers there are. So once you're into the billions or tens of billions of dollars of valuation, you've got very few buyers. You've got to go down an IPO path, and that doesn't look very attractive for most companies. Whereas B2B, you've got a lot more opportunities. So we analysed every single VC fund back in 2015, and almost every one of them, before we started to operate, was predominantly B2C. They've now pivoted. Most VC funds are really doing more B2B. And if you look at the B2C exits that have happened, look at Grab. Still, after all this time, its market cap is about $6 billion below the amount of money that it raised. In other words, it's lost more money than any other startup in the history of Southeast Asia. And if you look at startups...
We'll take that off a headline for any promotions.
If you're looking at GoTo, for example, it's probably not doing a lot better. So B2B gives you a lot more exit opportunities, and we think it's more of a sustainable business model.
And I've got a bit of a deeper dive question. This aligns with my... So with the B2B, how have you seen the potential for companies to scale for B2B change over the last 3 years? Because for my own journey, it went from needing to have lead generators, salespeople, implementation managers, customer success managers, account managers, team leaders above them, then someone else. And there's just these layers and layers of humans. But with how much everything's changed over the last couple of years, all those layers are just not required.
Absolutely right. You've got tools like Lemlist and similar things like that that will just take your list. Well, first you can generate lists in many different ways, but then they'll take your lists. You put in the pro forma emails or LinkedIn messages you want, and when people don't respond, it's a second message, a third message, a fourth message. And we send this to thousands and thousands of people on Alternatives.pe. And by the third email or the third LinkedIn message, people might start to respond. By the fourth, you get a lot of responses. And that's all done instantly without any human intervention, apart from the setup, which is pretty efficient. But you've got a lot of tools now making that B2B marketing and lead generation and really just getting you from that customer generation.
Onboarding, self-onboarding.
Yes, so it's certainly become much more efficient.
Service chatbots, you name it. Like, it's super exciting. And now
Zendesk, all those
now
things.
the SDR and AI tools. Sorry, for getting technical, SDR is sales development rep. It's the lead generation part. Like, it is super exciting what's happening in the B2B space.
Certainly is.
John, when I chat with you, what I love about you is, obviously we're sort of good news junkies. We like hearing stuff that's coming out. You're fortunate enough to have hundreds of portfolio companies across the globe. What has surprised you in the last 12 months have been the areas of growth or the sort of accelerated programs where really you've been surprised by how much it's grown in that time, or the ones which you sort of look at right now and think, what is this? What is the area that you're looking at that think you could blow up over the next sort of 2 to 3 years?
Yeah, that's a great question. So we've invested in about 400 companies all around the world. There's about, I think, 40 countries. And I'd say the thing that surprised me most is how mainstream sustainability has become over the last 3-4 years. It used to be you'd go to an impact conference 4 years ago and you'd be there with a few other quirky people. And there'd be some people talking on panels, but there wasn't a whole lot of interest, and now it's become extremely mainstream. And that's driven by the ESG efforts that are mandated now at many companies and at the government level. So a lot of interest in that. But just in our area, we provide management tools for GPs and family offices. So if you look at the regulations that are coming down the line the next year for ESG reporting for all of these folks, there's not a whole lot of available tools out there that are really good. So this is an opportunity for us and for other people that are developing tools in this area. So I'd say the big surprise for me has been how mainstream a lot of the sustainability stuff has become, but also in the area of like solar and hydropower and a lot of these other areas, how predictable all those returns have come. You can now predict based on the turbine that you choose for a wind energy-based system. You can predict to 2 or 3 decimal places the kind of return that you're going to get from that. And that wasn't there 10 years ago either. So I think the real thing for me is just watching all of the sustainability systems, but also the underlying technologies that are involved in the reporting and the measurement and facilitation of all of those systems. So I think that's a really big area for growth that we're seeing. And those companies, I'd say in our portfolio, if I visualize the top 10 companies in my portfolio, at least 3 of those are in that area, and they've come from nothing to be somewhere in the area of like 8 to 12 to 15x, which is terrific.
I think my summary of that is they're all coming for the revenue that consultants are currently getting from the big professional services.
Look, the consultants need these technologies more than anybody. Because if you go to the big consultants, I won't name them, but they basically are still working off spreadsheets. And if there's one thing that we're in the business of doing, it's moving people off spreadsheets onto technology that can replace them. I think Capital HQ is in the same kind of territory.
And for you, Zhijin, on the emerging technologies front, with technologies such as blockchain, such as the rise of the digital wallet, the digital banks, etc., how are you expecting them to sort of disrupt that whole financial, or not, maybe not disrupt, for another word, or enable more that whole sort of fintech or financial services ecosystem over the next sort of 3 to 5 years?
I think you covered quite a lot of how AI has changed our lives earlier in your presentation. I think very similarly, we're seeing that same change within the financial services industry. A16Z published something in their newsletter just a while back talking about how similar to the internet era, where what AI is doing was actually bring all of that existing financial services online, such as PayPal making payments available online instead of having to write a check. So now in this new AI wave or trend, we're seeing labor actually becoming a service. So similar to what you mentioned, what we're seeing is that a lot of these white-collar labor jobs, certain of the task functions are now being able to be augmented by AI co-pilots or agents, and this is happening across all financial institutions. The use cases are multiple, whether it's in customizing emails, in fraud detection, in automating processes. We've seen this in the news, JP Morgan offering LLM suites to their wealth management employees, JP Morgan using it, GS using it for example, data extraction, Nomura, and ourselves as well, right? We're looking to use various aspects of AI to help us with our day-to-day, whether it's better financial spreading, process automation, etc. I think all of this is extremely interesting. If you talk to most investors about GenAI investments, they are generally not focused on the LLM foundational model piece because that's generally going to be managed by the tech fins, right? They would probably look at some of the picks and shovels. So for example, tools that allow you to maintain data privacy as you're using some of these GenAI tools. Selectively, I think they will also look at the application layer, where there's very verticalized, specialized use cases that are being solved for. But at the same time, there's also some level of hesitation because the tech is evolving so quickly. You don't know if some of these fintechs are going to be obsolete in a matter of months. I think what could be interesting is also if you look at the flip side of AI, right? We all know how real deepfakes are becoming. So as you look at how AI evolve, it will be also interesting to look at opportunities that will be able to safeguard against the negative aspects of AI. Now, I cover a lot on AI, but I think within the capital market space, one thing that's a growing trend for us is really looking at shorter settlement times and collateral optimization. So the US equity markets has moved to T+1. Many markets are Canada, I think Mexico as well. Many other markets are looking to shorten their settlement cycles. Similarly, India, we're going to T+0, T+1. All of this are going to require better infra, better rails, better data management in order to allow for quicker transfer of assets and cash or cash equivalents. I was at the Asia Risk Conference last week. During one of the collateral margin management conference, the JPM rep was saying about how, for example, tokenization could be one of the solutions for collateral management. While we're not saying that blockchain is the one or best solution for this problem statement, but we have seen actually quite the first signs of commercialization in the aspect, right? Particularly in, let's say, like repo or in short-term yield enhancement. So for example, we see in Broadridge, they actually do roughly about, I think, $1 trillion in terms of repos per month. And what they do is basically just lock the collaterals and tokenize them so that via smart contracts, you can enable real-time transfer of share ownership, token ownership, for example. What we have also seen is in the money markets funds. We know that BlackRock, for example, tokenized Builder. And the use case there is really for CFOs to think about short-term liquidity management, right? How can they enhance their yield while maintaining that liquidity? And we're talking about AUM of roughly $2 billion in just a matter of months. So that we see as a growing trend as well.
For you, it must be an incredibly challenging job of, obviously you've got to manage from the strategic side, the bank's interest, but then also just the absolute onslaught of innovation that's coming in the fintech side. How do you, what are you reading? What are you looking at? Who are you following, etc.?
Well, actually, I would say it's exciting. It's great to have all this innovation. I think it's what gets me out of bed in the morning. I think for us, we are very much focused on working with the business because we are strategic investors, right? For us, commercialization and partnership is a key criteria for any consideration. So while we do a fair bit of outside in, a lot of what we're thinking about is working with our businesses and identifying the problem statements and going out to look for solutions for those specific problem statements. This is across the board. We actually kind of carry that through because we are looking for more than just providing financial capital to the startups or fintechs and really trying to see how we can add strategic value to both parties mutually, right? So for example, being a paying client, providing domain expertise, bringing them across the globe, giving them color regarding the landscape, either regionally, globally, just because we have that global footprint. So I think all of that comes into play.
Brilliant. And for you, Jeff, you've got investments in Ginkgo Bioworks and Twist Bioscience. For you, what excites you about the future of synthetic biology and also digital health?
Yeah, so,
And do you want to explain what synthetic biology is?
yeah, synthetic biology actually is something very related to sustainability and climate tech, right? So in fact, we are probably one of the first VCs here in this region who have been doing something related to impact many years ago, right? And so actually, as I shared with some other friends, actually we went to this sector by chance because I was supposed to go to Silicon Valley to meet up with Paladin Capital, which is a cybersecurity fund in DC. They have a partner based in San Francisco. So I say, if you have any cyber kind of deal you want to show us, he said, since you did semiconductor last time, let me show you this company called Trace. They use silicon wafer as a medium to synthesize genes actually automatically, right? So I think we on hindsight, we have a lot of learnings along the way about how simple companies scale and eventually reach where it is today. I mean, take a look at Ginkgo, right? We did make many times the return from investment, but the stock performance post the IPO, I mean, over the past 2 years has not been so actually satisfying for a lot of investors, right? So I think that definitely a lot of takeaways to learn from these companies. And certainly there was a hype, right, for some of the companies. And in the case of Trace, I would say actually they managed to end up their valuation already. Somehow they managed to establish the market kind of a position. And today actually they own a huge chunk of the market share for gene synthesis globally. And I think actually it's only a matter of time for them to turn profitable. I mean, in another 2 or 3 years' time. Riding on that, right, we continue to tap on opportunities actually in the SynBio, and I would say actually the real opportunity what we really see is actually is in healthcare actually. The reason why I say that is actually even though actually a lot of investors has been very excited about the potential of using, we call it a new form of production of ingredients actually to mitigate the carbon emission and so on, but there's a lot of challenges. There's a lot of challenges, and these challenges are certainly now the yield actually level you can achieve, right? And I see many companies actually trying to use E. coli and yeast to produce those kind of molecules that you can be used in cosmetics and some other industries. And at the end of the day, it really depends on the kind of price point of the product you're going to focus on. Very often what you see is actually those kind of high value, low volume products, they don't have enough kind of market size. Those kind of low price point but huge volume kind of product, I mean, with SynBio means that you can't compete with the commodity price today. So that's the issue. So that's why we kind of starting to focus a bit more on what we used to be good at. And enterprise software AI is actually is a very big thing for us. As you, Steve, you may recall that we were the investor for Unity software back in 2010, right? Because Unity, actually, we get access to a lot of the deals in the VR and AR over the past 15 years. But now, actually, and also because of that, we came to know the game industry and also entertainment quite a lot more. And so we are somehow now working on certain very exciting deals in AI for media. Because the movie production and animation production actually industry itself today is very inefficient. The production cycle is actually very long. And very often, when the director or the producer actually they realize something is not right, sometimes it's too late. They cannot change, and that will affect the quality of the final kind of the product you're going to consumers that you're going to get access to. So we are now seeing we're now working on certain opportunities in this space. We see actually there's going to be a lot of opportunities in this. We very much believe in AI can help to address a lot of inefficiencies in many of the productions. And so pharmaceutical industry, actually, as I shared with the audience last year, I think this is something we continue to see. Actually, we see many more new therapeutic startups actually benefit from either ML or Gen AI itself, right? So that's what we're working on now.
I think it's interesting. A lot of the US VCs talk about how you mentioned about the utilization of AI in the manufacturing, in the production process, how it can improve it. And then you got the likes of Kathy Wood who also correlates that with things like rights law, whereas the more products or more individual units that are produced, the actual decrease of cost going down, similar to like with batteries that being manufactured, solar panels, etc., and then combine that with the S-curve adoption of typically innovative products. It will be interesting to see, that sort of forms that thesis of why, the sort of the production of products going forward, does move into that sort of, there will be an abundance of different products.
Agree.
So final thoughts from everyone on the panel. Obviously, we've covered a lot of different areas in our discussion. I always love to finish panels with, a sort of a thesis on what you're looking at for the next sort of 3 to 5 years, but I'm going to slightly modify that. Basically, in what we do every day, we make decisions on where we're going to invest our time and energy and focus, because that's where we think we're going to optimize returns going forward. So my final question for you, John, is which segments or sectors are you investing your time and energy, or expecting to invest your time and energy over the next 6 to 12 months that you think will help Hatcher produce the highest returns for you as a company?
How much time have you got? Yeah, it's so
50
for us,
seconds.
Okay, 50 seconds. So what we've invested in a lot, we've invested millions in AI over the last few years. What we're investing a lot in now is integrating with multiple accounting systems. That sounds pretty dry and boring, but if you think of the wealth management industry or banking or anything, people have a tendency to get locked into a particular system, particularly if there's a lot of data on that system. So what we're investing a lot of money in right now is making sure, as a wealth management customer, you can move between different wealth managers, different banks, seamlessly, different fund admins, different GPs seamlessly. This is a really important step that we're working on now. So we're investing millions of dollars in our back office and making sure that our back office can support any kind of system that you may need it to support as a GP, as an LP, as a wealth management client.
And there's one area you're holding out on, John, that you haven't mentioned to everyone: carbon.
I did mention that actually in the sustainability area. We are investing increasingly. We're just setting up a green steel fund at the moment in Abu Dhabi. We just set up 4 funds this quarter in Abu Dhabi for different things, mainly for real estate. But now we're investing in green steel, green cement. These are pretty critical areas. Also looking at hydrogen and green coal. And so these are areas that our GPs that we're helping manage these funds actively raising on. So if you have an interest in those, please come and
the Sustainable
and
Concrete guys would love to have a chat with you.
Yeah, I saw them, but I ran over to their desk earlier. Yeah. Jason,
yourself, where are you? The same question for all of you.
Look, where I'm spending most of my time is on the growth credit for sponsor-backed technology companies. The risk return is better than anything I've seen in 20 years as an investor. So we're going into late-stage companies where we're getting 12 to 14% interest, front-end fee, back-end fee, monthly amortization, which gives you about a 17% IRR, plus warrants to share in the upside, which on average we believe will give us around 23 to 25%. So that's equity returns for senior secured amortizing loans in late stage companies backed by the best VCs around the region. And we're getting it because there's just a lack of competition. And in the US, the rates are much lower. The amount of warrants are much lower in this asset class, which has been around for about 40 years. And they've done quite well, but we're able to just get that benefit of new entry into the market. It's a lot of people at the early stage, no one doing it at growth stage.
Brilliant.
What's the minimum investment?
250K.
Zhijin?
I'm going to keep mine short and sweet. So technology agnostic, digitisation, and collateral optimization.
I like it. Jeff?
Yeah, well, we continue to focus on AI, continue to focus on deep tech, and play a role in bringing some of the companies to Asia, and by encouraging them to come to Singapore as well.
So
open to Australian deal flow as well.
There's a robotics kitchen company that would love to have a chat with you as well. All right, ladies and gentlemen, thank you very much for say a quick thank you to the panelists for that session. Really appreciate your answers.